Hey there. I'd like to welcome everybody to our virtual panel today. My name is Steve Stang. I'm a partner with Cherry Beckert. I lead our healthcare deals practice. And the panel we put together today, and I'm going to let the panelists introduce themselves in a few minutes, but the idea behind it was that every year at JP Morgan Week out in San Francisco, that there's a lot of, excuse me, casual conversations that happen. There's a lot of one-on-one meetings and everybody's hustle and bustle all over town, trying to get in the meetings, talking specific deals and things like that. But what's maybe was lacking this year was a lot of that just running into somebody on the street or running into them in a lobby while you're waiting for a meeting and just sitting down and chatting as to what's going on. What have you been seeing in the market? What do you think about this, that, and the other? So we thought we'd put a panel together today and sort of try to have that sort of a casual conversation for everybody and share insights maybe they learned during their meetings during JP Morgan Week, but also just any other insights that they may have out there. And so the approach we're going to take is we're going to go ahead and talk a little bit about just healthcare in general. Then we're going to do a recap of 2020, talk about the types of deals and size and multiples, things of that nature. And then we'll flip over to more of an outlook of what we think we're going to see coming down the pipe in 2021. What are some of the hot sectors that might be out there? What are investors looking for? What are sellers looking for? And then lastly, we've got a few other odds and ends that if we have time at the end, we'll jump into. Talk a little bit about the new Omnibus Budget Act that was just passed in December and what that might mean for healthcare, as well as a few other topics like SPACs and things like that. So the panel we put together today, I'm real excited because we're going to provide you 4 different perspectives. And I'll let each of them introduce themselves here momentarily, and we'll probably go clockwise. But we have Russell Bryan with Bailey Southwell, who can provide the investment banker or the seller's perspective. Sean Dempsey with Sheridan Capital Partners, more of the investor buyer perspective. Angela Humphreys with Bass, Berry & Sims talk about the legal implications and what she's been seeing from a legal structure in deals. And my background is more in the financial analysis and the quality of earnings, so I can provide some insight on that. So I'll go ahead and again, we'll go clockwise and let each of the panelists introduce themselves, talk a little bit about their background, their firm, and just give you a good feel for where they'll be speaking from. And Russell, if you want to go first.
Sure. Thanks, Steve. I'm Russell Bryan. I'm with Bailey Southwell, as Steve mentioned. We are an investment banking firm in Nashville and Charlotte. I'm in the Charlotte office. We are focused on advising healthcare providers or healthcare services companies, healthcare tech and tech-enabled services. And then we also have a growth business services or tech-enabled service practice separate from healthcare. Part of our tech-enabled services offerings also is a sub-focus in payer services, so we do some of that. We advise companies on M&A and growth capital raises. Typically closely held companies. We also have a fund, BSC Capital, that invests growth equity, not as sole sponsor, typically coming alongside other investors. We co-invest in acquisitions and buyouts with that fund. But our primary business is advisory, and glad to be here. Thank you.
Okay, thanks, Russell. Next, Sean Dempsey with Sheridan Capital Partners.
Yeah, thanks, Steve, and good to see everyone, I guess, virtually today. I'm a partner with Sheridan Capital Partners. We are a healthcare-focused private equity fund investing out of a $300 million vehicle currently. We target those businesses with 3 to 15 million of EBITDA, and really within 3 core verticals of healthcare. Those being multi-site providers, outsourced services, serving the healthcare ecosystem and products.
Okay, great. Angela?
Thank you, Steve. I'm Angela Humphreys. I am chair of the healthcare practice and co-chair of the healthcare private equity team at Bass, Berry & Sims. For those of you who don't know, Bass, Berry & Sims is the third largest health law firm in the country. And I personally practice in the M&A arena, focus my practice exclusively on healthcare mergers and acquisitions, working in large part with private equity firms and their portfolio companies and investments in the healthcare sector.
Great, great. And so, and from an audience standpoint, with questions, as we're going through the discussion today, there is a chat button that you can go ahead and type in any questions that you have. We'll probably just sort of look at those and try to accumulate them. And then as we get towards the end of the discussion today, we'll circle back around. If it's a question that you want one of the specific panelists to go ahead and address, maybe just put their name in the front of it and type the question in, and we'll make sure we get the right folks responding. But again, what we're hoping we'll have today is just a nice conversation. And so I'll throw out some topics, provide a little background before each one, and then just sort of have a give and take back and forth with each other. And so I wanted to start out with before we get into the 2020 wrap up, to talk a little bit about just healthcare in general, and what it means to the country, and not only from an investor standpoint or from a provider standpoint, but how does healthcare fit into what we do in our economy and everything. And what made me think about this was I read an article a little while ago that Dan Michelson wrote, and it was in Becker's Hospital Review, and he titled it "Healthcare Too Vital to Fail," and it was really a spinoff or a play on back during the banking crisis in 2008, when there was a lot of discussion: are these banks too big to fail? And what would happen with that? And of course, there was a ton of government stepping in and helping to save the banks and stuff. But it wasn't, is healthcare too big to fail, but is it too vital to fail? And going through this past year has been really a unique thing, because I used to always like to say that healthcare is one of those few industries that's somewhat recession proof, because everybody always needs healthcare and it'll always be there. But this was an unusual time because it turned into an economic crisis when so much of the country shut down, but also turned into a healthcare crisis with how are we going to be able to, provide the care that healthcare providers need, and get the supplies that they need, and the masks and the shortage, the run on a mask, and you couldn't buy a mask, or there was the toilet paper too, I guess. But I'm just curious, and I'm actually catching the panelists off guard on this, because I didn't tell them I was going to tee this up at first. But just getting their reactions in working in the industry, from a financial side and a legal side. What's your perception as to, is healthcare recession proof, so to speak? And without getting into specifics of what we saw in fiscal year 20 as far as deal volume and stuff like that, do you feel that it's an industry that is always going to be there, would always be a good investment, and is it too vital to fail?
I'll make a couple of comments, and if Steve, on that cold call, if you want. I guess you said not really to refer to 2020, but it's interesting that, and I'm sure that my other panelists can say this, can make the same comparison, but it's interesting that 2020 sort of was the first time that our volumes, particularly in healthcare services, got interrupted. But obviously that wasn't recession tied really to recession or lower economic activity. It was tied to a healthcare pandemic, when we had to close center or clinic-based services for a while just to protect everybody, or we stopped elective surgeries and that kind of thing. But if you go back to 2008 and the huge recession then, healthcare, Angela and Sean may nod their heads, was one of the few areas that received funding in M&A and growth capital. And so I guess then the market certainly thought, I'm okay with this. The other data point that I always walk around with is when I started, and it was, and this dates me, but it was 9% of the GDP, and it's 19 to 20 today, somewhat due to aging of America, et cetera. But It's, most of the technology and the success and service models is around companies that are going to help push that number back down as a percentage of GDP, lower cost and higher efficiency, higher quality. So, but I guess answering your question, it should be too big to fail. The question is, will the returns on it shrink because, we become more, we don't reward quality like we should, or payer consolidation, whatever. So that's just a couple of points.
Yeah, and to tag on to Russell's point, I think certainly, obviously, healthcare as an industry is too vital to fail. That said, that may not be the determinant of individual providers or companies, right? So I would liken it to the example of the big box stores compared to Amazon, right? Everything was going virtual before the pandemic. The pandemic only accelerated that. And I think the same thing is true in the healthcare industry. I think providers who had technology solutions or telehealth components that were either already online or that they were developing and were able to accelerate and roll out, weathered the storm in the pandemic much better than others, and in some cases thrived. So I think healthcare as an industry certainly is too vital to fail, but how individual providers are going to be affected and whether they are able to have long-term sustainability, I think is going to be due in large part to their adaptability and ability to innovate, particularly with increasing consumer demand and really demands for solutions like telehealth.
Yeah, I couldn't agree more with the comments that were made. I think looking at the stats, I think the healthcare spending went backwards last year, which was a shock, but not surprising given the comments that Russell said, just with the pandemic, that so much of the healthcare ecosystem had to shut down, right? Doing the right thing for their community, diverting PPE, but that has certainly rebounded. And you look at the projections for next year, and as Angela said, it's a story of the haves and have-nots, right? Technology is accelerating certain areas. There are those areas that are a little stale, right? And they're not succeeding coming out of this. So overall, healthcare certainly too vital to fail. I'm just thinking about the number of people employed in the healthcare ecosystem, the percentage of the GDP, right? The services that it provides overall. But will we continue to see a shift in kind of how those healthcare companies succeed and the dollars are spent? Absolutely. Those that are embracing technology, more outsourced services, looking to curb the cost in the system, right? I think those companies will continue to succeed. And on the provider side, certainly those businesses that have the aspects that are more non-discretionary, right? That visit that someone just can't put off. They have to go back to the doctor versus someone being able to prolong something for 12, 24 months.
Yeah, I agree with all you guys wholeheartedly, and I think it's a good segue into, as we do talk about fiscal year 20 from a wrap-up standpoint. And Sean, I'll let you start this one off. Is from the deals that you guys were looking at, not necessarily the volume, because I think we've talked about that, but talk a little bit about like platform versus add-on opportunities that you guys have looked at. And if you could maybe help the audience to define what do you guys think of, or what are you looking for a platform versus an add-on? So many practices and groups out there they all think they're platforms. Yep. They all can't be. Maybe sort of defining that and then going into a little bit about what you guys have seen from deal flow.
Yeah, it was certainly an interesting year, right? I mean, for a period where activity was just dead and people were focused on their portfolio, doing the right things for their employees, their community, right, and looking to ensure their companies could come out of it stronger. In reflection, it actually was a very good year for us. We did 26 add-on acquisitions across our portfolio, so very active. So that's really where we saw the majority of the time being spent working with the portfolio and on those add-on opportunities last year. We were not able to complete a platform just as the opportunities for new deals really dried up and then accelerated in the back end of the year, and saw some of those slipping into this year. We ourselves actually just completed a new platform, which we had been hoping was going to be an end of 2020, but slipped into 2021 now. And so it was interesting. I think we expected a lot of change and shift as to what an add-on would be. Maybe there'd be more structure added into it because of the impacts of COVID, multiple compression. But at least a lot of the things we saw was those sectors that were unimpacted by COVID and powered through, people's expectations did not change as to what was a platform, what was an add-on, and what their multiples were. And those sectors that were the hardest hit, the physician businesses, for example, I will say, a lot of the government programs that allowed these doctors to really weather the storm, right, allowed them to say, I see the value of being part of something bigger, and I think that's going to accelerate the trend longer term of consolidation within these physician practice verticals. But a lot of sentiment of, I'm not willing to take a discount today, right? I've got these handouts, I can weather this, and I will be back in touch with you in the fall. And that was something we really saw en masse. Being a good citizen, kind of doing the right things by your physicians, allowed those best-in-class providers to get a strong reputation during this time, and saw those physician businesses that are the clear add-ons, right, are the 1 to 5 doctors looking for a home, don't have that infrastructure. They really saw the value of being part of something bigger. But at least what was surprising to us, we didn't see as much structure in those deals or as much compression in the valuation as we anticipated.
It's interesting. And so talk, whoever wants to run with this, I'll talk a little bit about, there's when we start talking about the valuation compression, and everybody always wants to talk about multiples, but I'm not really going there, but this concept of COVID adjusted EBITDA. How have you guys been seeing the impact of COVID dealt with from a valuation standpoint? And ultimately, even how does that even impact deal structure?
I can chime in for a second. Most quality of earnings work, such as what you lead, Steve, is on the services side, is taking into account or looking carefully at healthcare providers, kind of what Sean talked about, whether it's physician groups or other center-based or location-based providers of healthcare that had to stop. Maybe you could look at, orthopedic practices that had elective surgeries that stopped and restarted because of either medical society or state mandates or healthcare system mandates to keep capacity correct. So COVID adjustments are common. I think common mistakes, or if people are looking at a COVID adjustment based on sort of a very high or peak seasonal number from the prior year or something like that. So you have to kind of be careful and make sure you're looking at sort of the average production of the provider group. But I think the lenders, if you want to look at really the basis or the most of it, and the investors are accepting them. They're reviewing them, but there has to be rationale behind them. I think they're also looking at least in the deals that we're working on, at what does the restart look like? Has there been a re-ramp? Has the practice or whatever behavioral healthcare business resumed its either visits, census, whatever you want to look at that it had pre-COVID, or I mentioned elective surgeries. Has that come back and is that sustaining? Because COVID isn't over, and some clients we've had have even had sort of some interim second interruptions, but usually there's a reason and they chose to do it as opposed to a state causing them to do it. And then one example is a behavioral health business that had a couple of it was doing different therapies and groups for, pediatric services, in this case, autism. And they had a couple of different groups that got impacted by contact tracing incident. And they said, we're just going to shut these centers that are affected for a while, clear the decks, and then come back. And then in that case, they transferred the care home through, home delivered services and through telehealth supervision. And they were able to do that seamlessly. So those are the kind of things I think that people are looking at.
Yeah, and from a deal structure standpoint and from the legal side of things, what I would say is in terms of valuations, we did not see COVID impact overall valuations, but what we did see was an impact in deal terms. And on the valuation side in particular, deals shifted from, an upfront cash payment with maybe 20% of rollover equity in a transaction to a lower cash payment, potentially an earnout or contingent payment to get security around return to pre-COVID volumes, which I would add has regulatory implications and challenges. But that's certainly something that was looked at in terms of deal terms, trying to shift part of the payment to 12 months out, once you could look at the volumes and improve out a return to pre-COVID volumes. And then we also saw a shift in rollover equity from 20%, in some cases closer to 30%.
Yeah, and one thing I would just add, I think that Russell was hitting on, there's not a magic, line that once a company clears X% to kind of pre-COVID levels that you can just plug the COVID hole, if you will. But I think it does start with the lenders and their acceptance of these COVID add backs. And in general, I think if you can see that trend within those businesses, and if it's at 100%, seasonally adjusted, great. If it's kind of trending from 90 to 95% and getting back there, you can certainly bite down on it. But one of the things I think we're finding is digging into really the geographies, and this is probably specific to our provider verticals, just that it wouldn't be surprising that there's certain pockets of the United States that have rebounded quicker, right, than other ones, and other ones are seeing continued kind of flare-ups more severely than other areas. And so I think really getting comfortable with that portfolio as well, that it's not just a blanket, the whole enterprise is back at 95% and heading towards 100%. Are there pieces that are at 100%, and are there pieces that are down at 80%? And what does that mean when you think about that add back?
Yeah. It's, and when we're looking at the Q of E, it just brings it to home that looking at a quality revenue analysis a while ago for it was an ambulatory surgery company's centers. And when you're looking at the monthly revenue analysis, in April was 0. And because literally the state had shut them down for the entire month of April, it just kind of brings it home the impact that some of this could have. I don't think I've ever seen a 0 revenue accrual in looking at a quality of revenue, but that's what it was. So the deals that you guys were looking at during this past year, or Russell, that you guys had brought to market, what would you guys say, was there any sort of common thread or a theme from deals that actually ended up failing, or maybe were deferred, but ultimately that you thought might close but didn't? Were there any kind of common undertones or themes there that buyers or sellers should be looking at?
Yeah, I mean, I'm pleased to say I don't think we have had anything failed. We did have more on our advice, some things that advised the client to put on hold, mostly when there was uncertainty around COVID closure or volume interruption. I would say, so those are mostly the true healthcare services, like patient-facing provider deals. And I would say to an engagement, every single one of those restarted, and the kind of, to Sean's point, the volumes met or beat, where they were, and they sort of continued on the trend line. So those sort of stopped and restarted, and there's many of them are sort of getting processed in the first quarter. I think if you follow that kind of thinking that, I guess there's kind of, to Angela's point, there were some folks that wanted to sort of push through and go ahead and, have the protection of a larger consolidated entity, whether it's physician management or, procedure-based companies. And so enter, some more earnout or contingent pay piece, or, I've certainly read about some deals that closed during COVID in healthcare services where the seller, I hadn't heard this word in a long time, basically provided the debt financing, seller financing, just to get it closed.
I had one of those.
Yeah. Maybe the one I'm thinking about was yours, but it was a physician deal. And so I hadn't heard about that in a while. Conversely, everything that we worked on that's healthcare information technology, tech-enabled services just powered through, closed, continues to go forward. And obviously the industry data bears out, that's the highest multiple piece. So hopefully that answers your question.
Yeah, that's what I can say. That last piece, Russell, as we look at our kind of verticals and where we see a shift in the pipeline, it's certainly in that tech-enabled, technology businesses serving the healthcare ecosystem, right? It was easy for them to transition to a remote work environment, continue to demonstrate value to their client base, right? And really just, I think, cemented in many cases that trusted partner, especially I can say for like one of our businesses, SpendMen, which provides a cost cycle management solution to hospitals, right? As they were focused on fighting COVID, having a partner they can rely on to optimize their cost and identify savings for them. It just allowed us to become more entrenched with our customer base, and business exceeded all of our expectations for the year. And so I think as we look forward, we just see more of those opportunities. It's that kind of recurring business model that weathered the storm.
Okay. Let's switch over to 2021, and there will be some overlap here. But as far as what kind of an outlook you guys are seeing, and I recently watched a webinar Andy Colbert at Ziegler had put on, and I'll quote his numbers here, but he mentioned that there's $30 billion of healthcare dry powder out there. We all hear the big numbers about how much dry powder, but actually it's $30 billion for healthcare in over 140 funds that they continue to raise funds specifically within healthcare. In 19, they raised twice as much capital funds that did in healthcare than they did in 18. So again, there's a lot of money coming in to be invested in the area. So as you guys look out, what do you see as being maybe the hottest sectors, let's just use that word hottest, from a deal flow standpoint and valuations?
I can start. I think the tech-enabled services, HCIT and tech-enabled services will continue. It was the highest valuation parameters received last year. Our numbers were, I think I have some slides, but our numbers were, it was stunning, 27 times EBITDA, and, for disclosed deals, and I think mid fours revenue multiples at 5. But I think so that'll continue. Physician consolidation will continue. Some people in the physician world, concerned about just volatility, and they never had to face any closings before, to my point about 08, 09, never. And so all of a sudden you have doctors that all of a sudden had to either get PPP loans or deal with, retaining provider staff or tech staff, back office staff, that they never had to deal with that. So that was volatility. But so I don't think the physician consolidation will take place by fear, but I do think that that made them sit up and look and see the benefit of being part of something bigger. Home care and hospice is extraordinary. I mean, the public multiple screen is at 20 times EBITDA. And some of that is utilization. Some of that is a little bit of a rate increase. Hospice obviously is continued. I think, as I mentioned autism before, there's 25 or 30 investor-backed platforms of different types. And that's still considered, you know, very fragmented. So I think that will sort of, there's a little bit of a slowdown, but I think that will start reemerging, or some of those platforms may start buying one another. In HCIT, virtual care, telehealth solutions, you know, accessing that got a big boost, obviously. So accessing care virtually, which is, I think, increased to the mid-teens and has settled down a little bit from there. But we never had payers supporting that till now, and Medicare is continuing their support of it, and I think that's here to stay. Commercial plans following. So those, I think, are a handful of areas.
And I would echo Russell's comments. I mean, we've seen a lot of activity in home health and hospice. Behavioral health is getting a lot of attention, but also we are hearing from our private equity clients in particular, you know, interest around value-based care models, taking risk. There were some interesting exits, some in the public markets, in those areas in 2020, in the wake of the pandemic, in the wake of COVID-19. And as you know, commercial payers and legislative efforts continue to push towards value-based care, I think that's an opportunity that's going to be of a lot of interest to private equity investors. But Sean, you may be able to comment on that.
Yeah, look, Angela, I think that's spot on. I think we've seen some big exits there, whether it's the public markets or SPACs, right? One and the same, I guess. But there's just a lot of attention on that value-based model right now. And I think with everything going on in DC, it's supported there. And so I think that's going to be a continued area of interest, and then those tech-enabled areas as well, right? HCIT. And so, you know, I think one thing that I am just finding more interesting now is, yeah, I think there's a lot more focus by sponsors of, you know, people really want to spend their time more targeted. You know, I'll use physician practice, for example. Russell was mentioning that, you know, people don't want to look at 20 sectors anymore. I think they want to pick their spots, and they want to say, these are the 3 I really like, right? Because maybe it's non-discretionary, it's more of a specialist, the fragmentation in the market, whatever it is, in really saying, I want to go deeper there. And I think that sets up interesting longer term here, especially as a lot of these areas have some platforms of scale already. And so you start seeing more of the, you know, consolidation of the consolidators, if you will, right? And is that helpful as you move up the sponsor food chain? And so I think you'll see some interesting dynamics, and people just being more thoughtful with their time in some of these end markets now.
I think a few times it's, you know, the technology has been mentioned, and also, you know, providers. I think the marrying of the two in a number of spaces is making a lot of sense and makes a big deal. Telehealth or telemedicine is something that we've also talked about. I'm curious as to what you guys are seeing there and from a deal activity, and I'll background that with, you know, for years, and even up until the COVID, until there were the waivers out there, you know, telehealth was looked upon, or telemedicine was looked upon as just being something to provide access to care in rural communities where people couldn't get to the care, and provide that. Where with COVID and the quarantines and everything else, and with the Medicare waiver to start paying for it, suddenly it got accepted as, you know, an alternative, not just rural, but locally, and the fact that you could actually get paid for it without having to go to a clinic and doing it. But it seems like that was a landmark mind shift of the country, really, of accepting the fact that, yeah, I can probably still get good healthcare virtually as opposed to having to see my doctor. But are you guys seeing anything in particular from the markets and deals, or are partnering telehealth with other providers, or what have you guys been seeing in that specific sector?
I mean, what we're seeing on the healthcare services side is that it's as you pointed out, it's a part of the delivery of some of our clients. I don't think that it's certainly in most physician management companies, short of some of the behavioral platforms where it's obviously long been in place, and I think is going to continue to support transformation of things like addiction treatment or other types of counseling businesses, to where the payers are going to require, far more outpatient or virtually accessed care because it's cheaper than building buildings and delivering it that way. But on the telehealth and the clients that I have is just in the behavioral health side, it's very important for them, although it's not necessarily the underpinning of their future value. It's just they have to be adept at being able to use it as they deliver their services, whether it's a therapist supervising somebody else who's actually delivering the care or whatever. And on other it sort of depends on the sector, I guess. But certainly within telehealth, there have been huge deals at big, multiples, because, as you point out, Steve, the payers have accepted it. They keep pushing forward, rolling forward the codes to allow it to be paid for. And that seems like that's going to stay in place. And the consumers adopted it and rapidly adapted it and adopted it, and the providers adapted. So it was interesting to see some of our clients who needed to use it quickly had tested different solutions and they were ready. And so it was a shot in the arm for the whole sector.
I think the practices that learned how to use it well and knew how to use it well during COVID, right? It spoke to the strength of those platforms, because for certain areas of medicine, right, it is a good tool. Behavioral is a great example, right? It should be part of that offering, right? Other areas, maybe some of the specialist platforms, right? It will never replace the doctor visit, but at least what we found is it's just a great engagement tool. Our dermatology business, for example, right? You want to be able to palpate the skin, right? But you can actually look using telemedicine and say, is that emergent? Do you really need to come in? That's a basic level you can kind of get over the hurdle of with telemedicine. But if it's not, at a minimum, it allows you to schedule that visit out 3 months, 6 months, right? So as you think about potential future interruptions with COVID or just the new normal, right? Practices that are able to offer that, know how to build it into their patient engagement, I think will just be increasingly important.
Yeah, and from a legal standpoint, one of the things we monitor, will there be a pullback of the waivers? I think no. It's hard to put the genie back in the bottle. People are used to the telehealth solution now, and so I think that remains to be seen for sure. But I think we're optimistic that the use of telehealth, as we've seen it in the pandemic, will continue.
Yeah, and I think chronic disease management, chronic care disease management is another one of those areas that, maybe with more of the primary care physicians could be a great area implementing it go forward. I'm going to skip around a little bit here real quick, but you mentioned hard to put the genie back in the bottle. And this isn't a big number, but for some folks out there, it could be quite a bit of margin. Sequestration payments. So those, those went into effect, that 2% Medicare reduction went into effect back in 2013, and then got waived during COVID and just got extended again. Angela, I'm just curious if you think, is that a genie that now that it's out of the bottle again, is it going to get put back in? In other words, are they going to reinstitute the 2% reduction sometime soon?
I don't have a crystal ball into that. But to your point, it's hard to go back. I mean, you look at the doc fix, we've had the doc fix for a long time, and I think we're going to continue to have that. So if I had to guess, I think it's probably going to be hard to go back.
Okay. How about as far as from a political standpoint? So we've got a new administration in the White House. We got a 50-50 Congress, and we have the House that's pretty darn close, or much closer than it ever has been from 50-50. Last year, before COVID, there was a lot of concern with the election and capital gains and stuff, and talk about trying to get deals done before the end of the year. And COVID kind of swallowed that. What are you guys hearing or feeling from a tax reform standpoint is coming down the pipe, both in 2021 or 2022? And what do you guys see that doing with deal volume and valuations?
Oh, it looks like Russell, I think you
Russell,
might be
you're
muted.
on mute.
Anybody who's been an M&A or investing in deals a long time has seen cycles where we fear, the expiration of the Bush capital gains cuts or things like that. I think it's pretty hard to advise people to sort of focus on that as a reason to do transactions, but closely held or what I would call provider entrepreneur or owner entrepreneur type companies look at that, and that's certainly causing, I would say it's a risk on type impact that brings, if you want to call it sellers or people who seek capital out of the woodwork, the possible increase of long-term capital gains, if that's where you're going. So we have lots of people who are expressing concern about that, and I have no way of predicting when that will happen, but all of these benefits or government benefits have to get paid for some way, and so tax increases will seemingly have to happen, whether it's on income or on gains.
And we honestly saw that impacting deal flow at the end of 2020. We had several sellers basically say, in view of the Georgia Senate race, that if we can't close the deal in 2020, we're going to wait and we're going to take a step back. So we had several deals where there was a big push to close by 12/31/2020.
Yeah, we saw the same exact thing. I think we see some people still feeling they should be doing something now. And I think that will drive some people here nearer term, but I agree with both comments that were said.
Yeah, some of the things that I've heard out there are just that, this is not from the investor community, but with COVID and COVID's still going to extend out for a while this year, there seems to be a feeling that tax reform is not really likely this year, but you never know. And it could, in that second half of the year, really put a push onto trying to close deals again if there's that fear out there. Earlier, Russell, you had mentioned home care and as being a hot growth area. And how much of that do you think is, PDGM went into effect January 1, but then it got sort of masked with COVID. To some of the expectation was, the stronger providers will do well, like everything else we said today. The weaker ones are going to struggle with it, and there would be much more of an acquisition market out there, or add-on market. But then they all got helped, with some of the provider relief funds and things like that to extend it. But what is your expectation from PDGM? Are we still going to see that sort of an exodus of those weaker providers from that, or do they seem to be coping better with it now?
Thinking of a couple of companies we're dealing with, they seem to be coping better with it. There was a rate update that went through this year, not material, but I think the the underpinning of acquisition consolidation, though, will continue for sure. So that's what I think is going to happen and is happening. CON states obviously are still provide some protection for somebody who's a smaller agency, home care agency. So those people can be a little pickier because the licenses don't get issued that rapidly. But I think that there's still going to be a lot of acquisition growth, and that is obviously priced into the public comps.
Okay. And Sean, you mentioned earlier in passing SPACs, and I can't remember which industry it was we were talking about, but if you could maybe just give a little bit of a summary of what a SPAC is, and for our folks that are out there that don't want to understand, and then maybe talk about how you think that might impact deals within the healthcare space.
Sure, I can give at most simple, it's a kind of single asset investment vehicle raised through the public markets. And I'm sure Angela could probably give a much more succinct kind of summary from a legal standpoint. But it's an alternate financing tool now. It's been amazing to all of us just how many have been raised. I was actually talking to someone the other day who is running a process, a sell-side process targeting just SPACs, because there's so much dry powder there. There's a little bit of perceived irrationality of you've got a clock that is ticking, right? That you need to find a company to invest in before you kind of have to unwind the SPAC. And so they're willing to pay a lot right now, right? And you have the hedge funds, the mutual funds that are sitting behind there providing these pipe financing tools, which allow them to acquire bigger businesses, and it creates a public currency. So it's interesting. It's being used by a lot of these kind of VC-backed businesses that maybe are pulling forward their IPO, right? Because it's allowing them to have less scrutiny and tap the public markets sooner than they may have traditionally. So I think it's a great tool for them. It will be interesting to see, more of these buy and build based businesses do some of those access the SPACs and utilize a public security to go on a buying spree. I think time will tell, but they're here to stay for the near term because there are so many of them and there is so much dry powder. Angela, I'd be curious if you've kind of worked with any of them yet, not to put you on the spot, but just the complexities of actually completing a deal with a SPAC. I just don't know how that will play out as you think about M&A processes. And I don't know, Angela, if you have a better perception of that.
Yeah, I have not dealt with one personally, but I am just surprised every day. It seems like there's another one, right? And with that comes all of, being subjected to public company reporting requirements and Sarbanes-Oxley and, things that the management team of, a company may not have familiarity with, may not have in place. And so once you're in the public markets, that may increase the need to augment your management team. And so there are a lot of considerations out there, particularly for management teams that are affiliated with these types of companies. But I do think that they're going to be here to stay at least for 2021, at least based on what we're seeing here in Q1.
Yeah, I think I read that there were over, not in healthcare specific, but overall there was over 250 of them formed last year, and a lot of them towards the end of the year. And Sean, you made that point about the time frame about it, and if I think I've got this right, is that they basically have to invest or acquire a company within 18 months,
18 months.
Or start unwinding it. And we've dealt with one last year, or maybe it was actually even the year before, I think. And it is interesting because there's a little bit more. One, I think they're willing to pay those higher valuations because of that time frame. But there is definitely a sense of urgency as they're out there looking for what is that asset that they're going to acquire. And so it's the deal that we had actually worked on ultimately didn't go through. But it was a different environment in working with them as opposed to working with like a PE fund and how they were looking at the asset. I'm going to hit on, let's see, we got about 9 minutes left. Again, if anybody out there has any specific questions, go ahead and put them into the chat room and we'll pull them up in a few minutes. One thing, I was going to hit a couple of other odds and ends here. And it was interesting because private equity has been in the crosshairs a lot in healthcare about people saying, is it a bad thing for private equity to be investing in healthcare, specifically with providers? I personally don't believe it is. But the FTC recently announced that they're starting to do an investigation into physician group mergers. And Angela, we were talking briefly. I think that was something you said you were a little bit up to speed on. Any thoughts on what might come from that ultimately?
Yeah, everyone I think is familiar with the Hsr Act, and if you have transactions above a certain size, you have to make the filings and go through the clearance process. That, however, is not where the government's authority ends. And so any transaction that the government thinks is potentially anti-competitive, they have the ability to investigate, even if it's not a dollar amount that equals the Hsr thresholds. And so in our analysis, what we typically tell clients is if you have market share approaching 30% and you're looking to do mergers or to combine two practices, or even in a private equity context to acquire practices that are all going to be managed by the same management company, even if operated independently in terms of billing and tax ID numbers, if they're all affiliated, that is something that the government can take an interest in and can look to investigate and can look to unwind. And they will do that between physician practices. They will do it with hospitals making acquisitions of physician practices. So I think overall, as we continue to see physician practice consolidation, and I think we're going to continue to see that, that's something that investors of all types need to be mindful of. Where do your existing physician practices sit in the market, and how do the targets affect your competitive position? And so it's something that we continually analyze when we work with our clients.
Okay. We did there's one question that came in, and I'll throw this out to the group. The question was, how will small rural hospitals that were struggling financially before COVID survive now? And I think you could have asked that question in almost any year with or without COVID, but
I don't have a magic bullet to that answer. Again, I'm not a hospital. I would just say without help from CMS in terms of rate subsidies or subsidies from other public entities, I don't see how they can. It's hard enough for larger hospitals to staff themselves to meet the demand. And so that's an easy out, but not being a not-for-profit or community hospital specialist, but just taking a practical view, that's what I would think.
Yeah, I think we're going to continue to see issues there. I'm actually dealing with that right now. I mean, they were small community hospitals, critical access hospitals. Many of those were struggling before the pandemic. And while there has been some relief with respect to government funding in the midst of the pandemic, I don't think that has been sufficient in all cases to address the issues that rural hospitals have. And so I think that's an area of where maybe we will see continued consolidation if operators are willing to step into those markets and rescue those hospitals. But I know of several counties, municipalities who are currently in the process of vetting, can we keep our hospital open? Can we get a third-party manager or buyer here to buy the hospital or to help us run the hospital? We can't long-term be in the hospital business. And so they're currently faced with the decision of trying to sell or get a third-party manager, or ultimately close the hospital, which none of them want to do, because it's a large employer in their counties or municipalities. It's important to the businesses that are there, but it's something that was an issue pre-COVID, and I think it's certainly been exacerbated by COVID.
Yeah, I think that likely outcome of continued consolidation, Angela, as you're saying, it seems pretty logical to me. Again, I don't spend a ton of time in the hospital space, but the margins being as low as they are across the industry, I think it's 1.5% is a stat I've seen, and that obviously assumes there's some that are more profitable and plenty that are losing money. But they are such important employers in their community, right? It is motivating for politicians to take action because they can't have that in their districts, right? And so I don't know if that motivates the government to take certain actions. At a minimum, I would hope it would ensure that they continue certain programs like the 340B program, right, that can help with funds for certain of these hospitals. But I think a likely outcome will be consolidation.
Yeah, I think you hit the nail right on the head, Sean, when you talk about the employment, because they're usually the largest or second largest employer in the community behind the school system. And which is one reason to say, I agree too, that the consolidation, or I'll just use the word loosely, affiliation, is where they have to go. And so much of our hospital system in this country is what I call just built for just in case. Everybody wants to have the stuff there just in case I need it, but they don't want to pay for it. And so I think the community hospitals are going to have to align with the larger providers and then streamline much more of what it is they're actually providing. If there's something critical needs, that you can quickly get to that larger tertiary hospital. But to be a provider of many services is just going to be a challenge. And the government's going to continue to have the supplemental funding for them. So, well, I think we're right at our time, but I wanted to go ahead and let each of you guys, I won't put you on the spot, but if anybody wanted to make any final comments or observations as we go. I appreciate everybody's time today, both the audience and attending, and each of our panelists. I found it very interesting and helpful. But members of our panel, any final thoughts that you want to share? Any sales pitches you want to make?
I'll just say it's going to be an active year from what I can see, and whether that's the health, if no pun intended, of the earnings of some of these providers, and certainly the the healthcare support companies seems to be strong, and I think it will be a more active deal year, notwithstanding still dealing with the pandemic, which is not over.
I think it's going to be a very active year, whether it's the add-on side or it's platforms that, as we talked about earlier, you can kind of see the winners and losers, and I think those winners people are just going to chase aggressively. And so, I just would say thank you to Angela and Russell and Steve. Great being on the panel with all of you.
Yeah, just to tag on, I think we were shocked at the number of deals that we closed in Q3 and Q4. And by all accounts, 2021 will be a record year. It will be a big year. There are several processes that we're involved in that are in play, auction processes, sponsor to sponsor trades, and that is just totally surprising where we were on March 12th. Of 2020. So I think 2021 will be a big year.
Yeah, and my last thought, I'd echo that as well, Angela. We were surprised. We actually tallied it up recently. And it was just under 100 healthcare deals buy side and sell side that we had worked on in 2020, which we weren't expecting. But we're very excited again about going into 2021. And thank you again to each of you guys for participating, and thank you to our audience. And we'll sign off.
Thanks, Steve.
Thanks, everyone.
Thank you.
Bye.
Thanks for having us. Bye-bye.